Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for October 29th, 2017. Market breadth with this past week's market fractional advance. Our bull-bear point and figure ratio at 1.59 declined from 1.83 last week, yet remained within bullish territory. The total count of securities in bullish or bearish patterns increased 3% to 3,212. The count of bearish stocks increased 12%, while the count of stocks in bullish patterns decreased 2%. The Pirls P&F Market Breadth Summary Chart shows us a market now 9 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the Pirls Stock Market Commentary email on a weekly basis free of charge, simply enter your name and your email address in the spaces required and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 178 points for the 10th decline in 27 weeks. At a positive 446.95 points, it has fallen below the April 2016 top and continues below the October 2017 top and the July 2016 top, and continues above all remaining 4 tops as well as all 5 bottoms in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in accumulation mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 4 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum. The CCI 20 daily in a Woody's uptrend is now at a positive 207.27, up from 5.01 last week. At Thursday 10/26 close, the CCI 20 daily was within the plus or minus 50 range for a zero line reject long entry signal at Friday 10/27 close. We will continue to follow this new trade simulation in next week's commentary. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 78 weeks ago, while the daily CCI 20 began a Woody's uptrend 7 weeks ago. The CCI 20 weekly at a positive 155.79 fell slightly from a positive 158.08 last week after forming a zero line reject long entry signal for Tuesday 9/5 open. Our rule is to stay in the trade until the CCI 20 drops below plus 100. We will continue to follow the result of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: some tech, S&P retail, and banking on top, oil services, gold and silver, and some tech on the bottom. Bullish, semis, and comp tech continue in the top 5. S&P retail and KBW Bank have entered the top 5. Gold and silver continues in the bottom 5. Oil services continues to lead the bottom 5. Brokers has left the bottom 5. Bearish, computer hardware has entered the bottom 5. Focus this week from www.zerohedge.com. Both cannot be right. The yield curve's ominous message. Something is very broken. The following are some key points and charts. 2 weeks ago, Deutsche Bank's credit analyst, Alexander Kochik, explained that with the yield curve becoming increasingly flatter, the Fed has roughly 2 more rate hikes left before it loses control, as the curve first flattens completely and eventually inverts, a precursor to virtually every historical recession. The problem, as observed here virtually every day for the past year, is that long rates have refused to sell off, and while they did move modestly higher last week in the U.S., other developed nations have seen even more flattening to compensate for the move in the U.S. Currently, the 2S10s is trading at 82 BPS. Since 08, it has almost never been below 80 BPS, compared to approximately 90 to 95 BPS in July 17 and 130 BPS in December 16. The further out on the curve that one goes, the greater the flattening, with the 2S30s now at 133 BPS versus over 200 BPS in December 16. There were also no material changes in the inflationary break-even rates or expectations. Here's why this is a big problem. As Schwetz lays it out for the nth time, in a conventionally recovering economy, tightening by CBs should move the entire curve up, indicating strengthening confidence and rising expectations. However, it is clear that while the short end is responding to growing probability of tightening, the long end is assuming that rising rates, instead of stimulating growth and confidence, would increase the chances of much more disinflationary outcomes further down the road. In fact, the more the Fed has tightened, the more the curve has flattened. From a practical standpoint, this means that while the short end is assuming that mixture of rate rises and liquidity withdrawal would result in higher cost of capital, the intermediate and long end of the curve assume that neither supply nor demand for capital can withstand higher cost of capital. And as we, Deutsche Bank, Bank of America, and many others have pounded the table previously, and now so does McGuire, both cannot be right. Flattening yield curves imply less liquidity and higher probability that consumption and investment would fall and savings rise. So what does all of the above mean? Well, as Kochik warned 2 weeks ago, and as Schwetz explained now, unless the entire curve starts shifting up, it appears that we are still in a world where CBs cannot tighten or withdraw liquidity. This in turn leads to another circular problem. The longer the Fed avoids the moment of reintroducing risks, the greater the eventual crash will be, That is the Fed's nightmare scenario. Or as Schwetz puts it, quote, there is, of course, a policy concern that persistence of low volatilities and high valuations are raising financial stability risks. While these concerns are legitimate, we can't see how price discoveries or volatilities can be reintroduced without a risk of significant asset value contractions that would bring forward economic volatilities that CBs are trying to avoid, end quote. In other words, for all the talk and posturing of tighter conditions and future rate hikes, Schwetz believes that, quote, central banks remain slaves of the system and a pleasant Kondrativ autumn is likely to endure, end quote. The alternative is the Fed losing control, something which is not allowed to happen, and is why stocks continue to hit all-time highs, ushering in the very unpleasant Kondrativ winter. Thank you for watching this week's Sand to Pirls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.